Okay, so we've talked about accumulation contracts, and we've also talked about why the New York Times calls private equity banking the secret of the affluent. Now let's give you some simple strategies on how you, whether you're affluent or not, can implement the power of a private equity bank in your life. The first step for most of us in implementing a private equity bank in our lives will be to just get out of debt. Here at the insurance team, we have the software and the training necessary to build you a cash value accumulation contract. Now, I would guess that only 1 in 1,000 insurance agents have even heard of a cash value accumulation contract. But we here at the insurance team know what it is, and we can help build those for you. So what you or your clients would end up with when you come with us is a customized turnkey debt elimination system that is based on proprietary software and comes with written guarantees. So why begin with debt elimination? Well, the problem with debt is that it eats up about 34% of all of our income. So for every $1,000 that the average American earns, $400 of that, or 40%, goes to taxes. About $230, or 23%, goes to our lifestyle, our fun, and our toys. 34% of every $1,000, so $340 of every $1,000 that we earn, goes toward debt service, principal and interest, which leaves us then only 3% left for saving and or investing. And by the way, it doesn't matter whether you're a high-paid surgeon or a school teacher. It's the same percentages for every $1,000 we bring through the home. So whether you bring in $5,000 by yourself or $20,000 as a household, how we spend our money is right what is shown there. So why debt elimination first? Leverage and arbitrage. There's just much more area there in that 34% than there is anywhere else that we can get a hold of. That's the average. And then with the power of a private equity banking program, we can also use arbitrage to get out of debt. So that's why we focus first on debt service. Let me give you an example of that. Return on investment. That 3% that you're shoving away into either a savings account or you've got going into a 401k as an investment or whatever, right? You've got a financial advisor. That 3%, if you were capable of getting a 10% return, which would be a pretty good return, probably before taxes and fees, but if you were earning 10% out there in the market, that's a pretty good return. And if you got that on the 3% that is typically saved by us, you just made $3 for every 1,000, right? Versus debt elimination. If you get rid of just 1% of your debt, you just put $3.40 back in your pocket. Well, which of those is the easier one to do? Now, a friend of mine said the other day, well, my advisor's getting me 40%. And I thought, oh, really? 40%. Okay, if you could get 20%, which is half of what he claims he's getting with his advisor, that would be $6 on the portion that you're saving or investing, right? Of that $30. Let's put that 20% into perspective. In Tony Robbins' book, Money Matters, he talks about Ray Dalio, who happens to be the most famous hedge fund manager on the planet today. Ray Dalio has a hedge fund with about $161 billion in it. And this is a hedge fund that's used by the 1% of the 1% of the 1%. And he has averaged, as Tony Robbins says, a mind-boggling 21%. Again, that's before fees and taxes, right? I saw another article out there a little bit ago that was published by CNBC Make It. The title to this article says, Warren Buffett warns against carrying a credit card balance. He said a friend of Buffett's recently came into some money and asked him for some advice. And the first thing he asked her was, well, do you have any credit card debt? And she said, yes, she did, and she was paying 18%. Warren Buffett replied to her, if I owed 18% on anything, that would be the very first thing I would do is pay off that 18%, right? He said, it's going to be way better than any investment idea that I could give you. He then continued, by paying off the balance, she would save more money on interest than any return she would get investing that money either in stocks or real estate or elsewhere, Buffett told her, right? He then said, and I thought this was interesting, I don't know how to make 18%. Again, am just trying to put that 20% because a friend of mine said that his advisor is getting him 40% into perspective. So if Ray Dalio and Warren Buffett struggle to get 20%, your local guy, maybe not. Anyhow, here's the point. If you could get even 10% of your debt service eliminated, that puts $34 back in your pocket instead of if you were investing and getting that 20% that we were just talking about, that would be $6. That's nearly a 6x return getting rid of your debt. That's what Warren Buffett was trying to say. That's the easy place. And besides, once you've eliminated that debt, you can always go and throw that money into an investment. So what happens if you wipe out 50% of your total debt? Now you've got an extra $170 in your pocket. So this is why we focus on it. Now let's bring it back to, say, the average American. In 2020, the average American household brought in $87,864. So 34% of that would be $29,873. Nearly $30,000, right? Think about that. What could you do with an extra $30,000 of liquid cash without getting a raise, right? Could you put it into savings? Could you put it into investing? Could you put it into your lifestyle? Could you divide it between all of them? Yes, 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 and yes. That $30,000 is like getting a raise, because without getting a raise, you're getting the same amount of money. So the question to ask yourself or any of your clients is, how would $30,000 of annual liquidity help you or the average American family? You see, as a loan officer, I look at debt elimination as a priority. Now, obviously, we've all run into those people that have good credit but just have too much debt. They're perfect clients for us also. But when you help somebody get out of debt, you've turned what was a transactional sale, a mortgage, into a transformational process in their lives. And so, like I just said, if you're a loan officer and you help one of your clients in less than 6 to 9 years put an extra $30,000 of cash flow into their pockets, what do you think they're going to do with it? Investment property? Bigger house? Exactly. So that's step one, eliminating debt. Step two is to become your own bank. I know, it sounds crazy, huh? But remember, this was the concept that the light bulb went off in Mike's head and he said, wait a minute, so you're creating the idea of a bank? Well, it goes further than just the idea, because you will have an actual cash value accumulation contract that allows you to stuff money into it and then use that accumulation to be your own bank. So that kind of begs the question, how do banks make money? I know, we all think we know this, and it's simple stuff, right? But a depositor comes into the bank, and they put their money in the bank, and the bank gives them 1%. All right, that's a lie. Banks only give us like 0.35%. But be that as it may, I'm just going to use 1% as a safe place, right? So a depositor comes in, puts in some money, and the bank pays them 1%. Later on that afternoon, somebody comes in and says, hey, I want to buy a car. And the bank takes that depositor's money, and they give it to the guy that wants to buy the car, and they charge him 6%, right? Which begs the question, what was the gross profit for the bank? They pay the depositor 1%, they charge the borrower 6%. How much money is the bank making? I know a lot of you are going to say 5%, but if you did, you'd be wrong. You see, if I can make a product for $1 and I sell it for $1 plus 5 cents, $1.05, I've made 5%. But if I make a product for $1 and I sell it for $6, $5 more, I've just made 500%. That's what the bank is making. Now, let's put that into perspective. The average margin, profit margin, for the auto industry is between 13 and 21 cents. In other words, for every dollar that it costs an auto manufacturer to build a car, they hope to get 20 cents in return, right? The bank just made 500. Okay, so how does all of this work? being your own banker. Remember I told you, with my cash value accumulation contract, I'm guaranteed 4% on anything I put in my account, and I can borrow guaranteed at 4.76. So the net effect to me in borrowing, I can get cash at 0.76. Now, let's say I wanted to buy a car. And if I were to go to my bank or my credit union, they would charge me, say, again, that same 6%. So if I want to be an honest broker with myself, what I would do is figure out what $50,000 at 6% would be over 5 years, and I would make those payments to myself. If I did that, what percent did I just make on my own money? 690%. So how does one become an honest banker with themselves? I know, an oxymoron. But I went to Bankrate, to amortization calculator, and I put in the 50,000. I put in over 5 years, and I said the interest rate is 6%. And it gave me a payment, $966.64. Now, if I were making structured payments, obviously we understand that. If I were making structured payments to the bank, I would be making payments on that car for 5 years of $966.64. And that would be at the 6% rate, right? And so what I would want to do is, although I borrow the money from the legal reserve insurance company, right, and I'm borrowing at 0.76%, I'm going to make payments back to my own account as though I was paying 6%. And that's why I'm going to make payments in a structured fashion at $966.64 a month. Right? Just as though I was paying it to my credit union. The beauty about it is an unstructured loan. So if I fell on hard times 2 years from now and couldn't make that payment, I don't have to, because payments back to a legal reserve insurance company are unstructured. You don't have to make them if you don't want to. But I want to be an honest broker. It's kind of like, or an honest banker. It's kind of like, how to explain this? A friend of mine he owned a fast food chain. After high school, I went to see him. I was probably 5-6 years after we had gotten out of high school. He owned a fast food chain, and he invited me over to see him. And I went to his store. It was a Wiener Schnitzel. I went to his Wiener Schnitzel, and he invited me to lunch. And we were in his office inside the Wiener Schnitzel in the back room, and we walked out to the front, and he walked through the line, and he paid for some hot dogs for us, and we went and sat down. Now, he paid for them because he was my friend, but I thought that was kind of strange. I said, "Why did you pay for your own hot dogs at your own store, man? You own the place." And he said, "Because I have to be an honest store owner. I have to control inventory." And so if you're going to own your own private equity bank, you need to be an honest banker with yourself, right? So if the going rate for an auto loan is 6%, even though you can borrow at 0.76 like me, you'd still want to pay yourself back at, say, 6%. Now, obviously, there's some of you out there going, "Oh, wait a minute, I could do this for my kids." Yeah, what about your kids? Because maybe you don't need a car right now. But what about your children that are starting to buy cars? Okay, so instead of charging them 6%, you charge them 3%, but you're still making a killer percentage. In this case, on myself, if I pay myself back at 6%, I just made almost $8,000 over that 5-year period with my money. And that's how we become our own private bank. Now, here's the problem we've got. We've been taught that there's only 2 ways to purchase cash purchases. Now, this is the Dave Ramsey way. Pay everything in cash, right? You save up your money little by little. When you get enough funds in there, in this case, the 50,000, you go buy your car. And as soon as you do that, your money goes back down to 0. Or the American way, we want things now. We go and borrow that 50,000 from a bank. We get the car and we pay that money back over time. In either scenario, we go back to 0. Let that sink in. Whether you pay cash or you finance, either way, once you've got your item and it's paid off, you're back at 0. Okay? What we weren't taught as individuals. Now, I got this in my MBA. I learned what opportunity cost was, but we have to understand there is an opportunity cost in everything we do. And in a business setting, I was taught to calculate the cost of capital or net present value of a company's capital before they went out and got involved in a project. I learned that in an MBA environment. But what I didn't think about is that I need to see my own family as a business. And so I should use a net present value calculation on everything I spend money on. Well, not everything, not bubble gum or whatever, but on large ticket items, I should be using the same kinds of formulas I learned in my MBA on my family. And so it wasn't until I read this by Nelson Nash. He said, we have to understand that we finance everything we buy. You either pay interest to someone else, the financing side of that, right? Or we give up interest that we could have earned. Again, let that sink in. We finance everything, whether we pay somebody an interest rate or we lose getting that interest rate, unless we're using private equity banking to build our own bank account. Now, I know I went through this a minute ago, but again, if my accumulation account can make $13,800 and I have to borrow money and spend $6,600 to get it, and I can net $7,200, that arbitrage is what we're talking about here. Again, that's what changes what Robert Kiyosaki says is a liability to an asset, because now borrowing money just became an asset. Other people's money just became an asset. So here's how it looks like when we add that arbitrage of an accumulation contract into our purchasing environment. So in my example here, this woman puts away $10,000 a year for 5 years into her cash value accumulation contract. And then when she gets to the point that she's got the $50,000, she wants to go buy her car, she uses that money as leverage, as collateral to borrow from the legal reserve insurance company, and she takes out a loan for $50,000 from them. Right? She gets her car. Boom. And she pays it off over time. After 5 years, like we saw, $50,000 is what the car cost. $13,800 is what she made in interest on her accumulation account. $6,600 is what she paid the insurance company for the right to borrow their money. And at the end of 5 years, she trades in her car. She buys another one. It's cost more, inflation, all that. Don't beat me up about that in my example here, please. But let's say she just takes the value of the car, she buys another one, she gets another loan for $50,000, whatever that new car would be, which is be a bigger value because she still had some equity in her car, right? But she does that. And then she does it again 5 years later. And then she does it again 5 years later. Now she's got $78,000 in her account. And then finally in the 20th year, she's now bought 5 cars over 25 years. She's bought 5 new cars, and she now has $93,000 sitting in her account. Not zero. She never went back to zero. And that's only having saved that money the first time for 5 years. But remember, we just got through saying that the average American family, by getting out of debt in less than 9 years, is going to have an extra $30,000 in annual liquidity. So let's say that she takes 10 of that and puts it into this savings account. And she's still got 20 to put into investing or lifestyle, right? But she's got that 10. And so every single year, she puts another 10,000 in. Boom, 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 boom. Now, at the end of those 25 years, she still has 5 new cars, but instead of $93,000, she has $463,000 in her account. Not bad for just a savings account, right?